Hello friends, today we will talk about 5 things that you should definitely know before you invest in any share. Before that, let's talk about a video which I posted about 2 weeks back on one of the share. The price was 600 rupees when I posted the video, and today it's around 686. So 15% return in 2 weeks. So let's see how to get it right, how to select and analyze stocks, what are the factors to consider to get it right most of the time, and how do we do fundamental analysis on stocks. Before we move forward, please like and subscribe so that you do not miss on more such content. So talking about smart investing in shares, 5 things that you should definitely check. First one is economy and sector check. Before you make any investment, just look at the overall sector, look at the overall economy. Second one is company credentials, very important. Look at the promoters, look at promoters holding. Third one is profitability and growth. Fourth one is cash and liquidity, and fifth one is valuation of the company. And that's what I call secret of smart investments. If you get these 5 things right, your chances of making a successful investment is very high. Talking about the next check, which is company credentials, this is very important. Before you invest in any share, please make sure you check shareholding pattern of that particular stock. How much is promoters holding? How much is holding by FIIs, mutual funds, and other institutional investors? If a share has higher promoter holding or higher holdings by FIIs, mutual funds, or other institutional investors, what it means is the promoters are also bullish about the stock, and FIIs, mutual funds, and other institutional investors are also interested in the stock. All these details are easily available on NSE or BSE's website. Just go to pseindia.com, look for the stock, and then you can see under shareholding pattern what is the shareholding of promoter or other public in that stock. And when you go into more details, you can get details of how much is the FII holding, how much is mutual fund holding, and other institutional investors holding in the stock. Similarly, it is also important to look at management strength, promoters track record before you invest in any stock. So this information is also easily available on internet. Browse companies website, news reports, and look at companies annual report. So let's look at the third check on profitability and growth before you invest in any share. The first one is return on equity. You should look at net income of that particular share as compared to total shareholders equity, and this will give you a good idea on the return that you can expect on that stock. Generally, stocks with lower return on equity, let's say 4 to 5% return on equity, why would you invest in those when you can get similar returns on the debt side? So invest in stocks which have decent returns on equity. The next one is growth rate in earnings. Look at revenue of that particular company. Look at sales of that company to see whether it is going up or down over a period of time. Look at growth in profits, whether profits are going up, going down. And lastly, margins. You should look at what is the operating margin as compared to sales, what is the net margin as compared to sales, and you can also compare it with some of the peers in the same sector. So these 3 checks will give you basic idea about overall profitability of the company and whether it is heading in the right direction or not. It's very easy to find these numbers. You don't have to compute them on your own. There are many websites like moneycontrol.com. Just go on the stock and click on the ratio button, and you will be able to see what returns this company is giving. Talking about the next one, which is very important, cash and how much is the leverage in the company. So the first thing that you should check, and many investors make this mistake, they invest in high debt companies which are not able to service their debt and finally go bankrupt. So first thing that you should check on the debt side is look at what is the debt servicing capability of the company, which is look at its EBITDA and look at what is its obligation in terms of interest and principal payout. It's a very simple ratio to find out how many times company's EBITDA is as compared to its commitment to pay interest and principal. So let's say a company which has a debt service ratio of 5. It means that its earnings are 5 times of its commitment to pay interest and payable, and therefore it represents high cash flows. But let's say a company's ratio is half, 0.5, which means it only has half of income to repay its interest and principal, and company could be in trouble. So look at this ratio before you invest in any share. The next one is debt and equity. This again is like a proportion of how much debt it has on its balance sheet as compared to total equity, and this will also give you an idea of amount of debt on company's balance sheet. Generally, this should be less than 2 for most of the sectors, except for capital intensive sectors where it could be a little higher, but be cautious when you invest in high debt companies. You should also look at what is the valuation of the company as compared to its peer, because everything else could be good, but it still could be a very expensive stock to buy. So first thing, which is very simple, is look at what is the P ratio of the company. P ratio is share price of the stock divided by its earning per share. So it represents what is the market multiple of that stock as compared to its earning per share. So let's say earning per share of a company is 10 rupees and its market price is 50, which means it is trading at 5 times its earning per share. If another stock is trading at 10 times its earning per share, then it's easy to compare that the second stock is relatively expensive than the first stock in the market. Now, P ratio would again depend on sector to sector, and companies on high growth path may have little higher P ratio. So you should be cautious when you look at P ratio of a company. The next one is price to book value ratio. This represents a comparison between book value per share, which is there in company's balance sheet, as compared to whatever is the market price. So let's say market price of a company is 150 and the book value of its assets per share is 100. So company is trading at a multiple of 1.5 times as compared to its book value. Now this again gives a representation of what is the valuation of this company as compared to other companies in the similar sector with respect to their books of accounts. So this also should give an idea of relative valuation of the company. So let's see how P ratio is computed. It's very simple. Take the current market price of the stock. In this case, we have taken Reliance Industries 1982. Look at what is the earning per share, last 12 months trailing earning per share for Reliance, which is 65. So the P ratio for Reliance would be 1982 divided by 65.55, which is 30.24. So Reliance is trading at a multiple of 30.24. Similarly, you can also compare price to book value. In this case, the book value per share is 736. Company is trading at 1982. So the price to book value ratio is 2.6. This is easily available. Just do Google on Reliance Industry share price and you will get this information. So do these 5 checks before you make any investment. Do not go by general tips which come from multiple sources. Make sure that your investments are successful. This video is made for educational purposes. Stock market investments are subject to market risk. Please invest at your own discretion after due diligence. Thank you. Jai Hind. Please like and subscribe for more such content.